Good morning. We're live. Welcome to Texas Capital Markets Virtual Summit. I know y'all are tired of doing these things virtually, but we will be back live sometime soon. I have faith in a vaccine or our scientists to get us out of this. Hey, thanks to these sponsors: Asset Preservation, Red Swan, CCIM, IRIM, Red News. That's us. Hey, in case you didn't know, Red News joined a bigger group, RE Journals. We have 6 publications in 17 states. And we're going to end up doing 150 events this year, including webinars. So good things coming your way. If you have connection issues, I'm showing on our dedicated server 5 bars. So we're in good shape this morning. Our speakers are in good shape. If you have anything, a glitch or somebody freezes up or the audio quits working, there's a little red reconnect button right at the top of your screen. Punch that button. That fixes just about everything. If that doesn't fix it, try Google Chrome. Make sure you're using that. You can always do this on an iPad or an iPhone as well, or an Android. So try a different device if that's your last choice. The chat room's on your right. So go in there, say good morning. I see Katie already did. Pop in there. Where do you work? What are you up to? Talk to each other in there. But that's also where you can ask questions of the panelists. So our moderator, Reed, will monitor that chat room, see if you can't get your questions answered. This event is approved for Texas Continuation Credits. Continuing, is it Monday today? So all you have to do is log in and log out. Make sure you log in on time and log out on time, and we'll track that stuff for your continuing ed attendance. We have some more events upcoming, multifamily virtual summit, and then economic forecast and South Central and Central Texas. Oh, I'm looking forward to this. So I'm going to turn this over here to Reed and let you all get going. I'll disappear, but if you need me, I'll still be here. So Reed, it's off to you.
Well, thank you very much, and welcome everyone. It's a gloomy day outside. It's a great time to be in a virtual webinar, so we're welcoming you here today. I'm chair of Wilson Cribbs & Gorin, a real estate boutique firm. We've been practicing real estate law and only real estate law for 35 years. Seems like a long time. We've got a great panel here to talk about capital markets. We're going to start with Lillian Farr, who is with Wells Fargo, great organization. Matter of fact, my son Palmer was in their leadership program for 3 years. And Lillian is in charge of a multi-state area in commercial lending and is a recent Texan and has a real strong background in CMBS. And so we may ask her some questions later on in the webinar. Next, we have Rob LaRue. Rob is with Grandbridge. He's been a financial intermediary for the real estate industry for years, bringing equity and credit from a very wide variety of sources. And Rob's son is a lawyer as well. He's actually a mud lawyer, but he clerked with our firm one summer, and we enjoyed having Ryan with us. Our third panelist is Rhonda Sands. Rhonda has been in real estate lending and with Texas banks for many, many years. Has serviced a number of our clients. I'm sure has serviced many of you out there in the audience. And she's currently with Veritex Bank. Got that Tex in the bank's name. I love that. Go Texas. And we're going to be talking to you about capital markets. Now, we all know we're in a very strange time. And I've been in the real estate business for many, many years. I've been through some good times and some bad times. And this is some of the strangest times we've ever had. But many of y'all may have participated in the ULI webinar yesterday talking about the future. And one of the things they talked about when discussing the future is that we have to embrace our present, and we just have to move forward accepting where we are. So starting today, I'm accepting where we are. I'm no longer angry. I'm just going to say, this is part of my reality. So we hope to help you understand the current reality in the capital markets. Now, we all know that there have been some winners and losers so far. We all know that hospitality, unanchored retail, mall properties, thumbs down. However, we know that multifamily, industrial, thumbs up. Then there's others, self-storage, office, grocery-anchored retail, somewhere in the middle where the decision on whether to purchase or sell or lend money is sort of an it depends. I've been seeing some interesting things coming over the internet. I saw some information from one of Rob LaRue's competitors out there in the financial intermediary market. And after reading their report, I thought it was really interesting because it seemed that they're saying that all types of real estate are attractive to lenders today as long as they're multifamily. So it's interesting to see what's going on. I'd like to turn it over to our panel and let them give their view of the commercial real estate lending market. And I'm going to ask each of our panelists to talk about their perspective and where they, with their company, work in the marketplace. I'm going to start with Lillian, then move to Rhonda, and finish up with Rob. So Lillian, you're going to start.
Well, good morning, everyone. As Reed mentioned, I work for Wells Fargo. I've been with the bank for over 19 years. I am currently in their commercial banking group. So my team in particular focuses on doing real estate loans, and we guide the commercial banking teams on which loans to do. We do all property types, except right now it's a little bit different. We'll focus on that a little bit later. My particular group does recourse loans, but don't let that stop you. If you are looking for non-recourse loan, we also have a commercial mortgage banking group at Wells that works with, they act like brokers and work with insurance companies to get you a loan from an insurance company. We have a real estate capital markets group. They do balance sheet loans, non-recourse, as well as CMBS loans, which we will talk more about later. We also have a multifamily capital group that my team works with, and they do agency loans. And so we have a variety. We have what you would call a buffet when it comes to IRE, investor real estate. My view of the market right now, the CRE world is, as we know, I think everyone has reeled it in a bit. But the good news is, as of recent, I think everybody's dipping their feet back in the real estate world. They're proceeding with caution. As you know, in the past, we've always looked on the history of performance. You've looked at your borrowers and seen, have they been through a tough time? How have they survived? How have they handled it? But this is a little different. I think COVID is very different, much different than anything anybody's ever dealt with. And so everybody's proceeding with caution. They're forward looking, right? What is the borrower's pro forma look like? How are they preparing? How are they handling, if they have tenants, how are they handling the real estate property in the current atmosphere? And obviously underwriting is a lot tighter now than it has been in the past. Lower LTVs, you're looking at how strong your borrowers are. So Reed, that's sort of my view of the CRE.
Let's turn to Rhonda. Rhonda, are you only in the business of recourse loans? Tell me a little bit about what y'all are doing over at Veritex.
Great. Yeah. First of all, I want to say Veritex is celebrating our 10-year anniversary. So we're very excited about that. We're currently an $8.6 billion Texas-based bank. And in early 2019, Veritex purchased Green Bank. And we doubled our size. And so we're 50% in Houston and 50% in Dallas. And we don't just do recourse loans. We also do non-recourse. We prefer some recourse, but we definitely have gotten into the market where we're able to burn off guarantees. We're bullish on development loans right now. A lot of multifamily, that's for sure. But we are also doing some spec industrial, if you can believe it, and in the right places. We did do a few spec industrial that was out of state, and we have brought that back into state and as well as a lot of the, if we get a new client, we really want the project to be in Texas within our footprint. We, as Lillian was saying, we are more cautious. We're underwriting definitely to tighter constraints. We are looking at the future, but we are not trending rents at this point in time. When we're doing our initial underwriting, we have to use today's rents. When we get the appraisals, of course, those are appropriately trended based on the economic conditions that the appraiser sees. But so we are seeing that. We're also using a little higher interest rates just because for that extra cushion. We also look at all product types. I would say I looked at a large office refinance just recently here in Houston. However, it was a special circumstance. It was a trophy type building. So not just, that's not something that we're just out looking for, but we do know that there are specific properties and specific locations that make sense. And so we're willing to look at those.
That's great. Yeah. It sounds like you're open for business, which is very exciting.
We are.
Give us the mortgage banker's view of the world. You have a very broad array of lending sources. Tell me what your view is of the commercial real estate lending market from the perspective of your various lending sources.
Well, Reed, unlike Rhonda and Lillian, GrandBridge is an intermediary, which means we're connecting people who have capital with people who need capital. And I would say that the capital providers here in the last several weeks have begun to thaw out a little bit. When this thing first hit, they were covered up with forbearance requests. They've worked through an awful lot of those, and they have turned their attention now to making loans. We represent about 20 life insurance companies, and on the debt side, and we're seeing a lot more activity. I talked to one of my correspondents the other day, and he told me they've got about $400 million in applications on their desk right now, which for a company that only does about $1 billion a year, that's a fair amount. Of course, they got a lot of catching up to do, but we're seeing a little more activity out there. And I would say that it's a much more conservative underwriting scenario than pre-COVID, but at least we're beginning to see them getting back out there in the market and making loans.
Rob, didn't you tell me a story about a 57% LTV loan that you were taking out to the market? And why don't you share with our viewers that story? Sure.
I had a client who was buying a grocery anchored retail property. We had one of the national grocers anchoring the asset. It's 98% leased. It was a pretty good sized property, 197,000 square feet. The grocer only had 8 years remaining on the primary term, but the occupancy cost is just 1%, was just 1%. They were paying about $5 a square foot in rent. And, so they were doing, and the sales were close to $600 a foot. So they had 3 5-year extension options at the same $5 rent. So I think the likelihood of their moving was pretty remote. I could have, in the strong days, or let's say this time last year, I could have gone to market with that deal and gone to 7 or 8 lenders and gotten probably 10 or 15 quotes, because a lot of them would quote it 2 different ways. I went to 22 lenders and I got 3 quotes. Now all you need is 1, but it just gives you that just shows you the state of the market at that time. This was about 90 days ago now.
Well, it seems that the consensus is that lenders are dialing it back and underwriting and loan to value, but they're out there making loans because that's how they make their money. They have to get some loans out there to have income. So let's talk about development lending. I mean, that's the most challenging part of lending. And who's open to business there? I mean, I'm going to turn this one over to Rhonda. She's already opened the conversation there. I'm going to let Rhonda start, then go to Lillian, and finish up with Rob.
Yeah, we remain bullish on development. However, we are dialing it back, as you said. We are doing a lot of multifamily construction at this point in time. We have brought in, since the beginning of the year, probably around 10 new quality borrowers that, they've been on our prospect list, and but because of the competition, we weren't maybe able to get out there because our pricing was a little more lucrative for the bank, shall I say. But now we've been able to get those because some of the larger banks have pulled back. And like I said, this to me is the time, and our management feels this is the time for the community banks, the regional banks, the local banks to be lending into the market. You can get in with the quality developers and maybe get a little bit more on structure and pricing, which helps us. And so we've done, in fact, this will be probably one of my best years that I've done in a long time, believe it or not. And most of that has been, I do have one retail project that I'm doing that's a redevelopment in Dallas. Then I've got, we're starting to look at the workforce housing. And workforce housing is different than the tax credit or the affordable housing, because affordable housing typically has some sort of government agency or some sort of tax credit restrictions, whereas the workforce housing is just, it's developed in such a way that the rents are lower and they're geared more towards your moderate income. And I've got one project that I've already closed here in Houston and another one that I'm closing tomorrow in Austin. And both of those are around $30 million construction costs. So we're able to handle that loan size. And we're finding that as something that's not quite, especially in today's time, people are going to want to live in that. So you're not going in and the competition isn't as great for a tenant. Another thing that we're doing is age restricted, 55 plus. I'm doing a project in Fort Worth for that one. And again, that's something that's kind of new, where it's not independent living. It's separated from independent living, which has services. This is just built, top quality. In fact, the project I'm buying or financing is like $250,000 a unit. But they can get higher prices because of all the amenities that they have. And so typically they are seeing that it's slower to lease up because people have to sell their homes typically to move into one of these. So where a typical unit is probably 12 to 15 units a month, they found that the 55 plus age restricted is probably more like 4 to 6 units. So it's a slower lease up period. Our pricing, like I said, has gone up a little bit. We have also, as I mentioned, doing spec industrial. We have done some retail, but it needs to be grocery anchored at this time. And it, excuse me, we have done non-recourse or gotten to the non-recourse with retail, but at this point in time, we're requiring that recourse stays on. It can be limited, but we are, expecting to see that.
So what's your loan to cost in these development deals today?
Yeah, even with some recourse, because we get the completion guarantee, and then, but typically it's 65% of the loan to cost. If there's going to be, we can get up to 70% if there will be some sort of guarantee that stays on. Mm-hmm. But at fully burn off, it's based on performance, we'll still be at a 65%.
What are the characteristics of the borrowers that you're looking for today?
Well, as I've mentioned, we're really in these type of times. It's an opportunity for the local banks to kind of go up in the chain, the food chain. So we're really looking for top quality. We are looking for very experienced. As Lillian mentioned, you want to see how they've done in the cycles. You know that they have the wherewithal to withstand, and the knowledge of how to withstand the downturns. And I agree with Lillian that this is unprecedented times. However, I do see that there is a similarity to kind of in 2008, 2009, where development just stopped, and there were still a lot of cranes up, but there were no new developments, no new construction starts for about 2 years. And then when they started, the developers were able to get in, and they basically just dusted off their plans and started over. And so, I think we'll see a slowdown in development towards the end of this year. Basically, my clients are saying that what they have on the table right now are they're going to go forward with, but the others have decided to drop them. I have one who just lost $650,000 and walked away from a project. So,
well, Lillian, tell us the view from Wells, the big bank view.
So I wouldn't say we don't do construction loans. We do all loans. There's a place for them, but I will tell you, we're definitely not bullish on construction loans. So as you know, with COVID going on and government funding coming in and people making, 600 more or 400 more on unemployment, it's been hard for, construction site folks to find certain employees, right? And so that's slowed down some construction for some folks, but we're definitely not knee deep in that market right now. So, but what we are doing is we are doing multifamily, we're doing some office, we're doing industrial. As Rhonda mentioned, we're definitely doing retail if it's grocery anchored. Those are doing pretty darn well. And our loans range anywhere. Our sweet spot's probably in my group. It's probably from $2.5 million to $20 million. That's probably our sweet spot. But right now we got loans going on from $2 million to $80 million. And then mostly are repeat customers, but we're also doing some loans with new prospects. Pricing probably on average right now is, L plus 225 to 250 on average if you're doing a floater. And it could be higher than that. It could be in the, in the low threes, up to L plus 275. We're doing 3, 5, and 7 year loans more. Usually we do a lot of 10 years. We do some of those right now, but we're, that's reeled in a little bit. So shorter term, just, because you don't know what's happening with the markets or where COVID has taken us. Hopefully it'll come to an end very soon. We're doing some 7 year loans as well. Spreads have widened, as we started, you started some deals before COVID happened, and, those kind of came to a halt, and you had to reevaluate what's going on. As you look at rent rolls, you got to see not only who's there, right? You used to look and say, okay, 100% occupancy looks great, but now you really got to dig down, who's asked for deferments on their rents of the tenants, is your borrower going to be able to continue to pay his loans if they're not paying him or her? So lower LTV, as Rhonda and Rob have both mentioned, lower LTVs, much more stringent underwriting, more conservative. So, and then we have covenants, right? You're thrown in, whether it's liquidity covenant, a debt service covenant of, you're just throwing those in just for safety nets. We do not know what's happening right now. And so that's what we're doing.
So Lillian, what are you doing in loan to cost for a development loan today in this market?
So if we were to do a development cost today, it would definitely be probably more than a 60% LTV, probably LTC loan to cost. Yeah, 60 to 65. Normally we would do higher, right? Normally we would do a 75% loan to cost, possibly an 80% loan to cost. But right now we wouldn't do that. And even with non-development loans, even with normal loans right now, your LTVs are lower. What you would normally do a 75% LTV on, you're probably doing a 65 or less right now. And as Rhonda said, a lot of players have stepped away. So you're seeing better loans, lower LTVs. We're seeing 50% LTV loans. We're seeing 40% LTV loans, which is great. But you still have to look at the overall picture, right? Because you don't know how COVID is going to affect values and how values are going to fluctuate due to what's going on. And so I think most lenders right now in the markets that are playing in the CRE world are being much more conservative.
Okay, Rob, let's go to you. Let's just say I bring you a client, out-of-state client, and they want a 70 to 75% construction loan. Can you get it?
We talking about multifamily? Multifamily is a little bit different.
You can just sort of go through the different food groups.
Yeah, let's do that. I would say if it's a commercial property, it's probably going to be challenging, unless you're talking about a credit tenant, single tenant, or perhaps if you have some pretty substantial pre-leasing for something like that. Otherwise, I'd say not. I would tell you, I would throw a property type in the mix that is probably more appealing to most lenders right now, and that would be medical office. I don't think we touched on that, all right, but mentioned that a little bit. But you know, we represent Fannie Mae, Freddie Mac, FHA, HUD. Those guys don't do development loans. I make a little bit of a distinction. When I'm thinking development, I'm thinking construction as opposed to a stabilized asset. And for something like that, I will say that on a multi, and this is a fairly recent, some of the life insurance companies do combination construction permanent loans. Right. And we've got one right now that we're working on that I think we've got a commitment forthcoming. It's a 70% of cost, full recourse.
Recourse during the development period, construction period, or full recourse, full term?
It's full recourse, yeah. And then there's a burn off, stabilization.
Right.
And I think that if I recall correctly, that one is priced around 4%. And I'll be candid and tell you, I can't quite remember exactly what that rate is, but somewhere in that vicinity.
Great, interesting. Well, let's move on to what I call the end game, which is the permanent financing market. And let's not talk about CMBS. We'll have a separate opportunity to talk about CMBS and complain about them. But I'd like to know who's open for business. And I'm going to go back to Rob because he's the mortgage banker, who's got a broad view. And Rob, as I was telling you, since all I do is sit in my office and look, or at home and look at the internet, I'm seeing all the different opportunities to borrow money that come over the internet. And we all know the internet is the best place to do anything. I'm seeing lenders interested in making cannabis-based loans. I'm seeing all kinds of what I would call a debt fund, which is anything that doesn't look like an institution, but is saying, hey, we would like to lend you some money. All kinds of alternative lenders. I'm seeing credit unions and even saw a bank. Just someone dialing for dollars, reaching out to their email address list saying, hey, I've got a bunch of money I need to put out by the end of the year. So tell me, what are you seeing in the permanent lending market today?
Well, as I say, I think most of the life insurance companies are beginning to loosen up. They're a little more conservative with their underwriting and a little more selective in their sponsorship. For example, let me give you a couple of examples. One of our life insurance company lenders is requiring 6 months of debt service in an escrow up front at closing. That basically, they're going to tap into that. It's an additional cost, you might say, from a borrower's point of view, that he has to put up 6 months of debt service. but that's what that life insurance company is going to tap into each month. And the borrower gets the benefit of the cash flow. He's not paying a debt service for those first 6 months because it's coming out of that escrow account. So that's an example of a little bit of a change in underwriting and how they're structuring deals. Life insurance companies are structuring deals. Probably LTV is an issue. They can go, most of these life companies can go up to 75%, but they're doing 60, 65%, somewhere in that range. I would say that a third issue is that they're looking at the sponsorship much more directly than they used to. These are typically non-recourse loans, that life and 10-year fixed rate, 2.5%, 3.5%, maybe 4% rates right now. And I would say that they're looking more closely at sponsorship, making sure that those guys don't have those borrowers, even though these are non-recourse loans. They want to make sure that the borrower doesn't have a bunch of hotel loans that might be dragging him down and creating issues for him. Things like that. They're scrutinizing the borrower a little bit more thoroughly than they might have in the past for a non-recourse transaction.
Tell me about the agencies. Everyone's worried about all these reserves that are creeping into the underwriting where you have to reserve your payments for 6 months or a year. What do you see the future is for the agencies and their underwriting for multifamily?
Well, perhaps this is a function of the PPP, but delinquencies are not nearly as daunting as they were expecting them to be. The agencies have backed off of some of that. And I would say that I think their rates are still, very, very solid. And I think the agencies are, I think they're returning, they're shifting back to normal. They got out front of everybody else in the forbearance issue, and I think they have throttled back on that a little bit now. So we haven't seen as much activity lately, but I think we'll see it here in the fourth quarter.
So Rob, I keep hearing about these debt funds. What are you seeing? Are debt funds really in the market? They're kind of the little tougher lenders out there trying to take advantage of situations. At least that's been my experience in the past. What do you see?
Yeah, they're definitely more expensive, and there's probably a place for them in the marketplace. But I would tell you that I'm afraid I'm old school. I'll try to work something out with a bank before I'm going to try to do a deal with a debt fund. But that's just me, and I'm not casting aspersions upon debt funds or on people who use debt funds. But I'm not going to say that's last resort capital, but it's going to be a lot more expensive than what the life companies or most other financial institutions are going to charge. There was a lot of the debt funds have been weeded out by this episode of the pandemic, but there's still a lot of them out there operating, and they serve a function like CMBS serves a function.
Rob, can I ask a question with regards to the debt funds? The pricing there was a period when they weren't that far off from bank financing, was it? It was a little closer, maybe 25, 50 basis points. But from what I understand, because of some of the, as you said, weeding out of the pandemic, that those prices have gone up. So it has gotten more expensive. Is that true?
Yeah, and yes. And yes and no. I saw some debt funds that were doing double-digit rates not all that long ago. Today, that number's come down some, and they're very fee oriented, 1, 2, 3 points on the front end. So they're very, very expensive. and you had a lot of weeding out. Today, I think I saw something yesterday, a debt fund that was 6.5, something like that.
Yeah, back in the day, we used to call that hard money.
Right.
A hard money lender. We would also call it loan to own. So they're underwriting the asset. They're figuring, I could own this asset for this amount.
Sure.
That's okay. I'll make the loan.
Sure.
Interesting. So, Rob, I also have seen people talk about credit unions. Do you see any credit unions in the market today?
Yeah, yes. Short answer, yes. A lot of the credit unions are similar to the banks in that they are typically going to require recourse. If not full recourse, then partial recourse. But that's not the case with every single one of them. There's one credit union with which we can't say we've closed a loan with them yet, but we're working with them. They're doing larger deals, 8 to 25 million, non-recourse. And their pricing is very similar to what life insurance companies are doing. So I kind of look at them as being almost like another life lender.
Right. So I'm going to go next to Lillian, but I have a question. And the question that came in on the chat room was, I'll paraphrase it. Can you get a loan on a hospitality asset today?
Can you get a loan on a hospitality asset today? So I'll tell you, we have a group called our Hotel Franchise Finance Group. And normally they're booming. They're doing so many hotels. So in short, first to start, yes, you can get it. You can get it somewhere. It'll probably come with a lot of fees. It'll probably be an extremely low LTV. You'll have to be an operator that's operated for a long time and knows what you're doing and been through the ups and downs and survived. It'll be costly, but yeah, I think you can do it. I would have to see the asset to tell you for sure, but yes. You know, one thing that's different out there, and you guys are probably all seeing it, is there's more upfront fees now. It's not even just about, spreads have widened, but it's also, you're going to be charged a bips or a 1-point fee up front on a lot of deals these days. So to go back to our Hotel Franchise Finance Group, they were just doing deals busier than busy, always moving. And now obviously that's all they deal with, and they usually deal with big operators, and now that's come to a slowdown. I've seen a fund that was created strictly for hotels.
Mm-hmm. Right.
This was a few months back, and that's all they're doing. They're looking for the hotel deals out there. And you're right, Reed, they're underwriting to knowing that, they can own that and keep it. And so that is out there. So in short, yes, you can get one, just not like you could in the olden days.
So Lillian, tell me what would be your sort of middle of the road permanent financing situation today? What would you be looking for? What kind of product types? What kind of loan to value? What kind of term on the loan? What would be sort of your median loan today in your group?
So right now, the loans that we like a lot, industrial is top of the list. We like the multifamilies. We like the office. Depends, with everybody working from home, you got to look at office and say, will a lot of these leases expire and not be renewed, right? Will businesses have half their folks working from home, half, come to the office? We don't know yet, right? And so office, we're still doing office loans. We're actually doing office loans right now, but we're cautious about them. We are doing grocery anchored loans as well. We're really not doing hotel loans. So I told you can get them out there. I didn't say you can get them with my team. But again, I don't turn any deal down until I've looked at the overall picture, right? you bring me a hotel that's a very low LTV and a very experienced operator. I don't know. I might be able to find a place within Wells, maybe not my group, that could do it. But until we look at the entire picture, who your guarantors are, what you're bringing to the table, what equity you have in there, we're not going to just turn it down. But a deal, we're looking, hopefully below 65% LTV, right? Normally, as long as, we look for 65% on special purpose properties, usually, your self-storage, your C-stores. That's what we normally, in normal days, would do 65% for. Other stuff we would do higher up to 75%, but not today, obviously. Today, most of the deals we're looking at are, I would say, sub 65%. Or 65, 60, 50, and some are really low. You'd be surprised. Some are like 40% LTV, so it's great. Again, as I mentioned earlier, we've got deals on the table right now that are anywhere from 2 million to 80 million, but our sweet spot is probably the 2.5 to 20 million deals. So I mentioned LTV. We do put covenants on our deals, so we would normally put debt service coverage, depending on the property type. We like 1.25 debt service coverage. What else? We like I said, our group does full guarantees. So you do look at the strength of the sponsor. So you got to have some skin in the game when it comes to our loans.
All right. So Lillian, as the LTV goes down, does your interest spread come down? You say you're a recourse lender. Do you have any burn off as you get down below 50% loan to value?
We've done some burn off, yes. And again, I'm in the commercial banking group. We've got other groups within the bank that definitely do full non-recourse, but for our group, we have done some burn off. We've done some limited guarantees. We've done some corporate guarantees instead of warm body guarantees. We prefer the warm body guarantees. And yes, your pricing is definitely better, right? If you've got a lower LTV, you've got a strong sponsor, you've got a great property, yes, your pricing is going to be, in the lower range. Most of we do fixed rates and we do floaters as well. But definitely your pricing will be less and your fees will be less if, depending on how great the deal is.
Okay, Rhonda, give us your view of the permanent lending market today.
Well, it's hard for us to compete. We typically don't go longer than 7 years, so we're 5 to 7 years. Our pricing, as I said, is a little higher. Where we can, we can't really compete on proceeds and the pricing, but where we can compete is in flexibility. We can do a fixed rate and there may be a prepayment penalty for the first 2 years, but after that, prepayments are allowed. So there's no lockout period. And we're basically looking at if it's a non-recourse, which as I mentioned, we do, it's be 65%, maybe 60%, 60 to 65%. And as Lillian said, and Rob has said, depending on the product type, it could go down to 50%. It just depends. And with regards to on a recourse, we could probably do 70%, whereas as Lillian said, it may be a 75, 80%. But it would not have been above that, and so we're definitely dialing it down a little bit. But again, it's flexibility that where we can compete.
You're all fully prepayable, or do you ever have any lockouts or any back end fees for?
No, what we may have is a prepayment penalty for maybe the first 2 years, and depending on what rate we have agreed to, it could be a 2-1-0, but it could be 2% in the first year, 1% in the second year, and then, no prepayment penalty after that. We are looking at some customers that did fix their rate 2 years ago, and it looked like a really good rate then, and now it's 5.5%, and so they've come back and asked for a lower rate. We are considering that because there isn't a prepayment penalty, and depending on how we can we don't want to restructure it. If it's all the only thing we're doing is the rate reduction, we are looking at that. So, but no longer interest only period, because we've got to be real careful of structured debt. Troubled debt restructure. So if you lower the rate and you increase the interest, interest rate only period, it doesn't work. So, so that's where we are.
The examiners get on you for that, don't they?
Yeah, exactly. So you can't, which is why you hate to lose a loan. We're all looking for the outstandings. As I mentioned, I've got my portfolio this year has been basically construction loans. Yeah. So commitments are over $100 million, but loans outstanding are zero. So of those commitments. So I hate to lose a term loan out of my portfolio at this point in time. So that's where we can work. But yeah, if you start messing too much with your interest only period or extending the amortization period or anything along those lines, it can create a red flag.
All right. Well, let's move on to talk about everyone's favorite topic in the real estate industry, which is CMBS. And when I made our outline, I entitled this the CMBS bitch session. So what is the future of CMBS? I mean, people love to hate them, but I tend to think that if they will give you more proceeds and a lower interest rate and it's non-recourse, a lot of people in the future may continue to hold their nose and go the CMBS route. I'd like to let EchoLillian start because she did a lot of work for Wells on the servicing side of CMBS. And I can tell you from our client's perspective, the servicing side is the biggest negative of CMBS, because if you try to get an amendment or a refi or increase your proceeds or get approvals for different things and easements, you go into the defeasance process. All those things sort of are prefaced with an So, EchoLillian, tell me a little bit about what you see as the future for CMBS, particularly from Wells.
Well, I'll tell you, I heard a lot about CMBS. Yes, you're right. I was part of the servicing world for many years before this role. And I also led the defeasance group. So I got quite a bit of complaints. To me, what is the future of CMBS? CMBS is going to be around, and it's going to continue to be around for a very long time. Where else can you go and get more proceeds, a great interest rate, and do interest only, for 10 years, right? They'll give you 10 years IO. They're even doing it today. So I think they're going to be around for a long time. I think it is a love-hate, relationship. People have their ups and downs in the market. Most folks, if they don't have to prepay their CMBS loan or don't, you usually have either a prepayment penalty or a defeasance that you have to do. And they are both painful and costly. And when you don't have to do that, that leaves a better taste in folks' mouth about CMBS. You are correct when you have to do any kind of amendment, right? If you're replacing your management company, if you're replacing a large lease, if you've got an easement, whatever you have, you've got to go ask for permission. So it's like you own the property, but you really can't do what you want, because technically a CMBS deal is part of a big securitization. And what some folks don't understand is when it's part of a securitization, the servicer, right, has a fiduciary duty to the investors in that securitization. And so you've got these documents, your loan docs and your servicing docs, that strictly tell a master servicer exactly what they can and cannot do. So if Rhonda's my CMBS client, she comes to me, she says, "Hey, Lillian, I want to replace this, my management company with my cousin to come in and do the managing for me so I can save money." Well, it's not that easy, right? I got to review it. I got to look at it. You got to make sure the loan stays with these amendments as good as or better than it was when you originally originated the loan. So really, the good thing I will say about Wells Fargo, we have a very large CMBS origination side, right? We're usually the number one originator out there, sometimes number two, but normally always in the top two. And I will tell you, every loan we originate, we also master service. So, you know, if Rob gets a loan with us, a CMBS loan, they can't say, or they shouldn't say, oh, I don't know who to reach at my servicer, because, you know, we will be there. You can reach out to your originator and they will connect you. So that's great. Another thing I will throw in real quickly is it always has to go to the special servicer. And the special servicer usually has skin in the game, and they own the first loss piece. And so they usually have a lot more say about what can and cannot be done. So the master has to get it over to the special. And that's usually what hinders things and gets fees in there. So that's why it makes it difficult. But in the end, I think, Reed, it's going to be around for a very long time. Again, I go back to, you're not going to get 10-year IO anywhere else. And you're not going to get a 75% LTV or and great rates. So it'll survive.
Lillian, I got to tell you, I agree with your comment about it having its ups and downs. In 1998, I went to work for a CMBS company. It was called Crimmy May.
I remember Crimmy.
You remember Crimmy May? Yes. My first day was the day they declared bankruptcy. I started calling it Crappy May after that, but they were the biggest buyer of BC property or BC paper back in 1998, and so I immediately got back into banking, and that's where I've stayed. So, but anyway, and it's still around. That was 1998, and it's still here. So I agree.
I'm going to let Rob talk about it because he's directly originating those CMBS loans that we all hate.
Yeah.
We all love.
Yeah.
That's right.
There's the EchoLillian. There's definitely a place in the market for CMBS. She's correct. You can get some IO periods in there. Their pricing may not be quite as sharp necessarily, but it's pretty attractive. I mean, it's not off by too terribly much. I got a quote. One of the 3 quotes that I got on that on that shopping center deal I talked about earlier was a CMBS quote at 3.5%, which was probably as low as my 2 life company quotes. But they're a little more forgiving on the sponsorship. You might have a borrower who a little bit of a scratch and dent borrower. Maybe he's got a credit hiccup, or he really needs full 75% proceeds to get out of another loan or something along those lines. And, you know, they'll provide a 30-year amortization, drop of a hat. Life companies have a tendency to, you know, maybe more closely do a 25-year am. So there's definitely a place for CMBS. One of the problems with CMBS right now, though, is the fact that there's just a lack of product out there. One of my CMBS friends was telling me ordinarily they do probably about 10 deals a year, 10 pools a year, participate in about 10 pools a year. And he said, you know, they'll be likely to do 3, 4 this year. And that's just because there's just not that much product. The CMBS production is just way down this year. And as a consequence, a lot of the non-bank CMBS players have closed or disappeared, shall we say. And some of them have been acquired or merged. So there's, not quite as many people doing that right now.
So there's been a consolidation in the market.
Correct.
But go ahead, Lily.
I was going to say that's a great point, Rob, that you also threw in. The 30-year amortization is a big deal for folks too, and not many people out there do it, but CMBS does it all the time.
Well, and seeing that offsets the 30-year amortization, offsets the interest rate differential. Maybe a life company does a deal at 3.5 on a 25-year AM, and CMBS will do 3 3/4 on a 30-year amortization, and make the numbers work.
Right.
So I think we all agree, CMBS, with all its faults, it's going to be around. There's a place. People love proceeds. People love a low interest rate. and they'll provide it. So we're at the end of our time, and my outline said we were going to have some bold predictions from our panelists, but in our preparatory call, there wasn't anyone who wanted to make any bold predictions, so I just went out there and read the Wall Street Journal and read what Fed Chairman Powell is saying, and in his economist speak, it wasn't as clear as I would like, but when you read the whole article, I think he's guaranteeing low rates for a long time. And that's good for real estate. The only thing that I see as a lawyer that gives me a little concern is we're going to shift from LIBOR to something else, probably SOFR, which is the secured overnight financing rate. That'll occur at the end of 2021, but that's a really boring topic. So we're going to let everyone go at this point. Low interest rates, a long time to come. Looks like the lenders are out there. They're interested. Maybe they're looking at things under a little more of a microscope, but they're interested in acting in lending to real estate. So thank you very much, and thank you to my panel.
Thank you.
Sure.
Thanks.
Reed, we'll have to have you back to talk about boring topics, because when LIBOR changes, I think you're right. We're going to have to have a lot of conversation.
2 or 3 people signed up for that one.
Right. Well, but the 2 or 3 of us are going to enjoy it. Thanks, everyone. We'll see you at the next panel. If you're watching, go back to the lobby and click on the link for panel 2. So you'll see the panelists and their topic and the link in the lobby. I'll put a link up here in the. Just give me a second. Make sure you close down this window, though. There's your link. You should see it in the chat room right now. See you all in a bit.
Thank you very much.
Thanks.
Thanks, everybody.
Bye-bye.
Enjoy it.